Okay, let's continue now. We were doing estimation of working capital. In that we have done with operating cycle method. We are done with an existing company analysis. In new company also we have done few problems. Let's do maybe one or two more problems. A newly formed company has applied for a loan to a commercial bank for financing its working capital requirement. To prepare an estimate of the requirement, 10% to cover unforeseen contingency. Information about the P&L is given: sales, COGS, GP, admin, selling, PBT, provision for tax. COGS has been derived as follows: material used, wages and manufacturing expense, depreciation, less stock of finished goods, and COGS is 15 lakh 30. Figures given above relate only to the goods that have been finished and not to work in progress. Goods equal to 15% of the production are in progress on an average, requiring full material but only 40% of other expenses. 2 months of consumption of material in stock, cash balance 40,000, lag in payment 1 month, suppliers extend 1.5 month, credit sales are 20% cash, 70% income tax has to be paid. You are required to make other assumptions as you deem necessary for estimating on cash cost basis. Okay, I'm going to prepare first a cost sheet. The focus will be on the cost sheet only. If you look at the two questions which we did till now, they said 31,200 is the production, WIP was 12,000. Another question said 1,04,000 is the production, WIP is so much. In this question, what they have done is they have given the cost sheet to us. So good part is cost sheet is given. The trouble with the cost sheet is they are saying the figures given above relate only to the goods that have been finished and not to work in progress. So this is not a good cost sheet, because in cost sheet I have to consider for even work in progress. Another issue is this question does not tell what is the production. The production information is not given. So my assumption is 100 units have been produced. I go back to, I'm going to convert this question like the previous question. In the previous question 1,04,000 units were produced. This question 100 units are produced. WIP is 15 units. WIP is 15 units, in which the degree of completion for material is 100%, others is 40%, and the cost per unit was given directly there. The cost per unit is divided by 100, 8,400 per unit, divided by 100, 6,250 per unit, divided by 100, 2,350 per unit. Now it becomes like the previous question. It becomes like the previous question. Everything I have divided by 100. 8,40,000 by 100. The cost is, so when I look at the previous question, it said raw material 80 per unit. Now raw material is 8,400 per unit. Wages was 30 rupees. Now we have calculated some 6,250 per unit. Depreciation is 2,350 per unit. Estimated level of activity is 100. Work in progress is 15. It exactly becomes like the previous question. It becomes like the previous question. Production is 100. WIP is 15. Raw material cost is your whatever the number we had calculated divided by 100. 8,400 per unit, wages and manufacturing expenses 6,250 per unit, depreciation is 2,350 per unit. Let's prepare the cost sheet. We'll do the cost sheet under both total approach and cash cost approach. Estimation is only, cash cost is required. This is just for understanding. Anyway, I'm not going to do the estimation part. Let's start with the cost sheet. Particulars, total approach, cash cost approach. Direct material, in that opening raw material add purchase, more or less this format. Some addition here and there can be there, some extra items can be there. My opening raw material is 0 and 0. Raw material consumed given in the question is 8,40,000, but that's not the right number. That is only for 100 units, whereas we are producing 100 plus another 15 which needs 100% material. It needs 100% material. So 8,400 into 115. 8,400 into 115 is the raw material consumed. 8,400 into 115 is the raw material consumed. Closing raw material they have mentioned in the question is 2 months of consumption. 2 months of consumption is the closing stock. So into 2 by 12. Purchases is a balancing figure, 1127. Purchases is 1127. This is one part of it. Direct wages is 2,350 per unit. We had calculated, sorry, 6,250 per unit. Your wages cost would be incurred for 100 plus 15 into 40%. The degree of completion is 40%. The degree of completion is 40%. So 106 into 6,250. 106 into 6250. Wages and depreciation were, sorry, wages and overheads were clubbed together here. Depreciation is 2350 per unit. So 2350 into 106 and this side 0. In this approach we don't consider it. I put a total. No opening WIP. Closing WIP is 15 units into 8400. 15 units into 8400. We made an assumption of 100 units. WIP was 15 units. 6 units into 6250. 6 units into 2350. Even depreciation will be considered for stock valuation. 6 units into 6250. 6 units into 2350. This side, this depreciation part will not be there. 6 into 2350 will not be there. In cash cost, depreciation is not considered. So you get to 17 lakh and 14 lakh 65. 17 lakh is what is given in the question. In the question somewhere there was a number of 17 lakh, which is this number. Closing FG is 10%. 10%. My COGS is this. This is what would have been given in the question, 15 lakh 30. COGS given in the question would have been 15 lakh 30. It's not COS, there are other expenses also. We have other expenses like admin, selling. Admin is 1 lakh 40, 1 lakh 30. COS number, this profit and sales. Profit is 3 lakh, sales is 21 lakh. And when you do cash cost approach, it's 0 and 15, 88, 500. So I've converted like the previous question. What I did is I assumed 100 units as the production. We got raw material as 8400 per unit, wages as whatever the 2350, 6250, and got to the answer. Beyond this, I'm not doing it. Beyond this, its estimation is more of a formality. Your stock of raw material, stock of WIP, stock of FG is already calculated in this. Any doubts on this part? Clear? Let's come to question 13. Marks Limited is launching a new project for the manufacture of a unique component. New project means new company. New project technically becomes new company. At a full capacity of 24,000 units, the cost per unit is material, labor, fixed, depreciation. Selling price is 200, selling expense 10, 80% being variable. In the first 2 years, production and sales are as follows. Production, sales. We have to assess working capital, statement of profitability and working capital based on total approach. Statement of profitability and working capital requirement. Statement of profitability is basically the cost sheet. I'm going to just do the cost sheet again. Again, cost sheet is what I'm going to do. Working capital estimation is just a formality. You'll have to take number from there and keep doing multiplication, division, some into 2 by 12 into 4 by 52, some percentages you'll have to do and you'll get to the answer. So let's focus on preparing the cost sheet. We'll try to prepare the cost sheet. In the first year, 15,000 is the production, 14,000 is the sales, closing stock is 1,000. Closing stock is 1,000. Next year, opening stock is 1,000, production is 20,000, sales is 18,000. What is the closing stock? Closing stock is 3,000, not 2,000. It is 3,000 because there is an opening stock of 1,000. Opening stock plus production minus sales will be the closing stock. Let's do this now. We are required to do it under total approach. It's a new company. Year 1, year 2. Opening raw material is 0. Opening raw material is 0. Year 1. Let's first do year 1. Opening raw material is 0. Raw material consumed is, in year 1 the production is 15,000. Another important information is there is no work in progress in this question. There is no work in progress. If there is a work in progress, we need to inflate this 15,000. We need to inflate this 15,000. There is no work in progress. So 15,000 into 80. 15,000 into 80. Closing stock of raw material is 3 months. So into 3 by 12. 3 months into 3 by 12. Purchases balancing figure is 15 lakhs. Purchases balancing figure is 15 lakhs. Then we have labor and variable expense 15,000 into 40, 6 lakh. Just give me a minute. manufacturing and admin. If they had used the word admin and manufacturing, I would have taken it below. They have used the word manufacturing and admin, which is 20 per unit. Can you tell me what should be the amount here in year 1? 20 into what? Year 1, what should be the manufacturing and admin expense? 20 into what? What should I multiply this with? Then what is the difference between labor and variable expense and fixed manufacturing and admin expense? Why should they use that word fixed there? Okay, I'll do 20 into 15,000. Okay, next year what should I do? How can I write the same thing for both? Next year the production is different, no? Then you cannot do 20,000, you cannot do 15,000. 20 is into 24,000. At full capacity of 24,000 units, the cost per unit is calculated as under. This calculation was done on a base of 24,000 units. Variable expense by rule will keep changing. 40 into 24 I can do if you produce 24,000 units. What happens in fixed expenses? If produce less also, your fixed expense does not come down. So 20 into 24,000, depreciation is 10 into 24,000. Depreciation is 10 into 24,000. So 25 lakh 20, no opening WIP, no closing WIP, cost of production, no opening FG. This divided by 15 into 1, divided by 15,000 into 1,000 is the closing stock. 1,000 is the closing stock. COGS. Then they have said there is some selling expense of 10 per unit. In that 80% is variable. Fixed is 2 rupees. 2 rupees will be multiplied with what? Fixed 2 rupees will be multiplied with what? 24,000. Your fixed 2 rupees will be multiplied with 24,000. Variable of 8 will be multiplied with the units sold. With the units sold. So 2 into 24,000. I'll call this as fixed. And variable is 8 into 14,000. We get cost of sales. Your sales figure is 14,000 into 200. This gives the profit for the first year. Profit for the first year is 2,88,000. When it comes to the second year, my opening raw material is 3 lakh. Opening raw material is 3 lakh. Raw material consumed is 80 into 20,000. 80 into 20,000. We have produced 20,000 units in the next year. 80 into 20,000. Closing raw material is raw material consumed into 3 by 12. Into 3 by 12. Purchases is balancing figure. Can you tell me what is the purchase figure? Balancing. 3 plus something minus 4 is equal to 16. 3 plus 17 lakh minus 4 lakh is 16. Direct wages and variable overhead is 40 per unit. So 40 into 20,000. This is same 480 and 240. Same 4,80,000 and 2,40,000. Opening stock is 168. This is 20,000 units. This is 1,000 units. Your wish whether you want to follow FIFO method or average cost method. Both methods will give you different answer. I think just a minute. Question has given something, I remember. Okay, average cost. Stock of finished goods is to be taken at average cost method. So average cost method, we have done this in cost sheet chapter. Cost of production plus value of opening FG divided by units produced plus opening FG units into closing stock. So 4,69,714. This 48,000 will remain as it is. Your variable cost is 8 into units sold. 8 into 18,000. Cost of sales, profit and then sales. Any doubts on this? Any doubts on this part? Your fixed expense has to be on the overall capacity of 24,000 units. Okay, we are kind of done with your estimation part. Your working capital, the first segment of the chapter is over. MPBF part is also taken care of. Next segment is on the cash management side. On the cash management side, I have one problem on preparing something called as an optimum cash calculation and maybe 2-3 problems on cash budget. Let's look at this. A firm maintains a separate account for cash disbursement. Total disbursement are 260 to 500 per month. Administrative and transaction cost is 25 per transfer. 25 per transfer is like 25 per order. Ordering cost per order. Carrying cost is 7.5% per annum. Carrying cost is 7.5%. Determine the optimum cash balance. So square root of 2 into annual demand of money into ordering cost is called transaction cost divided by opportunity cost or carrying cost. 2 into annual demand of money is 262,500 into 12. How much? 262,500 into 12. 31 lakh 50,000. Transaction cost is 25. Opportunity cost is 7.5%. See, there it used to be a percentage of purchase price. It is 7.5% of technically 1 rupee, because your annual demand is in rupees. There the annual demand was in units, so we were getting the price of 1 unit and then multiplying. So 7.5% of 1 is 0.075. 7.5% of 1 is 0.075. You'll take a square root, you'll get to the answer. 45,826. Question can expand further and say how many transfers will happen in a year. How many transfers will happen in a year? You will say 31 lakh annual demand divided by quantity value per transfer. Total ordering cost, here it can ask total transaction cost. Average inventory, here they can ask average money which is being maintained by the company, half of your optimum cash balance which you calculate. So whatever is asked in EOQ, the same thing can be asked here as well. Go through question 15. Go through 15. Okay. Prepare monthly cash budget for 6 months beginning from April 2017 on the basis of following information: sales, wages and salaries. Of the sales, 80% is on credit, 20% for cash. 75% of the credit sales are collected within 1 month, balance in 2 months. There are no bad debt losses. Purchases 80% of sales and are made on credit and are paid in the month preceding the sales. Firm has 10% debenture of 1,20,000. Interest is to be paid quarterly. Advance payment of tax. Cash balance, any surplus or deficit above is made up by temporary investment or liquidation at the end of each month. Interest on this is to be ignored. So basically I'll have to keep a balance of 20,000. Above that or below that, I'll put it in an investment or I'll borrow that money based on requirement. Let's start. Cash budget for the period of April 2017 to September 2017, 6 months. April to September. Opening cash. The most tricky part or the difficult part would be the collection from customer. If that is done properly, problem will almost be simple. Opening cash is 20,000. Add inflows. Cash sales, collection from customer. Cash sales and collection from customer. I may split this further. Cash sales and collection from customer. What the question has mentioned is, of whatever sales is happening, 80% is on credit, 20% is on cash. So let's quickly close the cash sales part. 16,000, 20% of sales, 12,000, 16, 20, 16, 12,000. collection from customer, the rule is simple. What they're saying is 80% is on credit, 20% is on cash. Whatever credit sales is happening, 75% of the credit sales will be collected in 1 month and the balance in 2 months. Now listen, January month sales, I'll collect 75% of the credit sales in which month? Feb, and 25% in March. Least bother about January because it's not that in my period. So now listen, I'm going to write it like this, from Feb sales. From February, some part of it would be collected in the month of April. I can do it as a separate working note rather than clubbing it here. I am doing it here, but you do it as a separate working note. From March sales, from April sales, from May sales, from June sales, from July sales, and from August sales. September sales will not be collected now. September credit sales is not going to be collected now. September credit sales is not going to be collected now. Now the rule is 80% is credit sales. So I'm writing here February in bracket 96,000, 80%. February in bracket 96, March in bracket 1,12,000, April 64,000, May 48,000, June 64,000, July 80,000, August 64,000. So this is the credit sales, and now I know how the collection is going to happen. 25% of this in the month of April, 25% of this in the month of April, 75% here and 25% here, March month, April and May. This 64,000, 75% here, 25% here. This 48,000, 75%, 25%, 75 and 25. This 80,000, 75% and 20%, 25%, and this is 75%. So this way we have collected the collection figure. You can do it as a separate working note, or you do it this way, whatever way you are finding it comfortable. Better to do it as a separate working note rather than making it in the main working note. Apart from this, I don't see any inflow being there. There are no inflow being there. Purchases are there, some interest payment is there, advance tax payment is there. So there are no other inflows. You can have some borrowing to be taken. If you have a negative balance, you may have to borrow, or if you go below 20,000. If you go below 20,000, they said, which is the minimum desired cash, any surplus or deficit will have to be made by temporary investment or liquidation of temporary investment or temporary borrowing. So I may borrow money, that could be an inflow, but that will come later. As of now, I cannot write. So these are my total inflows. Total inflows. Cash sales and collection from customer. Cash sales and collection from customer. In the payments, in the outflows, the first item of outflow is purchase amount to 80% of sales are made on credit and paid for in the month preceding the sales. Paid for in the month preceding the sales. Now, it is slightly tricky. The part is not very clearly mentioned here. Listen, purchase is going to be 80% of sales and are paid for in the month preceding the sales. So I am not sure whether the purchases is done in the month of sale or they do it previous month. If they are doing previous month, when are they paying is also not very clearly mentioned. What is the credit period given is not clearly mentioned in the question. I am assuming that it is 80% of previous month. 80% of previous month. So payment to supplier, are paid for in the month. Okay, So your payment will be, for example, in the month of April, you will pay 80% of May month sales. April, the payment will be 80% of May month sales, because it is paid in the month preceding the sales. So sales of May is 60,000, this would have been 48,000. 48,000. 60,000 is the May month sales. Your purchases is 80% of sales. Purchases is 80% of sales. In the month of April, I am going to pay for May month sales. In the month of April, paid in the month preceding the sales. May month we will pay 64,000, 80,000, 64,000, 48,000, 80,000. I am paying May month in April, June in May, the previous month. Apart from that, there is some interest to be paid. Interest of 1,20,000, this has to be paid quarterly. So 1,20,000 into 10%, 12,000. Quarterly payment is 3,000 per quarter, which is in the month of April 3,000 and July 3,000. January, April, July, and every 3 months you have to pay this. Every 3 months you have to pay this. Apart from that, I think there is an advance tax. Advance tax is 5,000 in the month of July. So these are total outflow. Total outflow. Closing cash, borrowing / investment, revised cash. I may get a cash balance which is more than 20,000, but I don't want to maintain more than 20. The rule is very clear. If you have more than 20, 93,000, I'll create a deposit of 73. I'll create a deposit of 73,000. I'll have a cash of 20. Next year it is 20 opening balance. You get a closing cash of 44, deposit 24,000, your revised cash is 20. Get a closing of 8,000, borrow 12,000, closing is 20. Deposit 8,000, 20. Deposit 44,000, 20. Is there a wages and salaries also? Okay. Then maybe typing error. I have not written the point on wages and salaries. So I'm not sure where is this wages and salaries coming from. Okay, it is there. But when are they paid is not mentioned, no? Okay, this wages and salaries would be paid as it is. They have not mentioned the time period. So let me take as it is then. Sorry, I did not see this wages and salaries. Wages and salaries, assuming they are the payment, 9,000, 8, 10,000, 10,000, 9 and 9. So now 64,000 of deposit, 16,000 of deposit, 22,000 of withdrawal, 2,000 of withdrawal, either you withdraw money or you deposit money depending on the cash flows. 64 minus 16, 22, 2 minus 35 and 9. This is the temporary either liquidation or you create a deposit or you borrow money depending on whether you have surplus money or not available at your end. The most important part is this. Be very clear on this collection part. This collection part is the most critical part in a cash budget. Go through question 16. No, do the class one. Okay, let's quickly discuss. If needed, we'll solve it, or else we'll discuss this question. Slide Limited is preparing cash flow forecast for the 3 months period of friends, please. Friends, Jan to end of March. Following volume have been forecasted. So December to April sales is given. Selling price is 600. Sales are all on 1 month credit. So simple. Your Jan, Feb, March collection would be this into the previous month. Previous month sales into 600. No splitting it further and all. Production of goods for sale take place 1 month before sales. Each unit produced require 2 units of raw material costing 150. No raw material inventory is held. Raw material purchases are on 1 month credit. Now listen this carefully. Jan month sales. Production will happen in December. Production will happen in December. Purchase will happen in December. Payment for that will happen in Jan. In short, Jan payment is for Jan month sales itself from a raw material point of view. Raw material point of view, January you will sell the product. You are going to produce that in the month of December. Raw material you are not holding, so you will purchase in the month of December and you are going to pay. In short, payment to supplier. Payment to supplier will be this into 300, this into 300, this into 300. The same month because production happen, sales happen in January, production for that happen in December, purchase for that happen in December and payment for that happen in January. In short, payment happens for the same month of sales. Payment happens for this is for raw material. So raw material, if you see, payment is equal to, and hence payment is equal to sales month. Payment is equal to sales month, only the raw material part, okay. Then other thing, variable overheads and wages are equal to 100 per unit and are incurred during production and are paid in the month of production. So my wages and variable overhead will be 100 into the next month sale. 100 into the next month sale, because the production will happen 1 month before and payment is done immediately. Payment is done immediately. Raw material also should have been next month sales only, but in raw material what is happening is you are given a 1 month credit period. You are given a 1 month credit period. Opening cash balance is 35,000. 2 lakh is expected to be received in the month of March. So this is a loan which is being taken and you will purchase a machinery. So this will give you, there is a loan which is taken and there is a purchase of machinery. Apart from this, they are asking forecast current ratio at the end of 3 month period. Forecast current ratio at the end of 3 month period. Few points which I can say. One, there will be a closing stock. There will be a closing stock. What will be the closing stock is 2250 units. Closing stock will be 22. Why will this closing stock be there? Because you produce 1 month in advance. You produce 1 month in advance. Production happens 1 month prior to the sales. So there will be a closing stock of FG of 2250 into, FG will be 2250 into 400 rupees. What is 400 is raw material cost of 300 rupees and labor and overheads of 100 rupees. So this is the closing FG. There will also be a closing debtors. What is closing debtors is you are collecting 1 month later. So whatever March sales has happened, you would not have got the money for that. That money would not have come. So 2100 into 600. There is also a cash. Closing cash is there in the cash budget, which is 902 500. 902 500 when you prepare. There will be one item of current liability. What is that item? One item of current liability. That is creditor. What I said in creditor is you sell in the month of April, produce in the month of March, purchase in the month of March, payment in the month of April. So there would have been a creditor. So creditor is for the April month sales. I would have done the production now. For the April month sales, I would have done the production now. While doing the production, I would have also done the purchase of raw material. I would have done the purchase of raw material. So this is my current asset. Assuming there are no other thing, this should be my ratio. Assuming there are no other current liability, I don't see any other information at least in the question. Just a minute. I don't see anything else. So your current ratio is 4.54 is to 1. The current ratio is 4.54 is to 1. Balance question on this you can manage it. 17th one question is only there that you can manage. I'll now move to an area called as receivables management. In receivables management, we are going to broadly classify the chapter into two parts. One is on your extension of credit or tightening of credit, which is a purely format driven. I think we may do some 6-7 question. Every question I'll do only same format, nothing beyond that. It's a format driven question. I'll first explain the format to you. We'll write sales less variable cost less fixed cost and call this as gross benefit. Gross benefit is or technically the profit which you get. After this, a company can have bad debt, cash discount, credit admin cost, interest cost and net benefit. I don't see anything beyond this being there in any of the question, but if there we'll see, but mostly this is what you are going to do in every question. The next I think some 6-7 question, nothing beyond this. This is the format we will put in. When you have to calculate this, there is a note which you need to do, which is you need to estimate debtors. Interest cost is dependent on the debtor figure. Debtor is calculated based on full cost of sales. Debtor is calculated based on full cost of sales. Normally the formula for debtors is, when you did working capital estimation, debtors is equal to credit sales into credit period by 12. This area says don't take it on credit sales, take it on cost of sales, like we had a cash cost approach under. If the problem is silent, we do it on full cost of sales. Problem tells us to do something, we'll follow that. If the problem is different, we'll follow that. Based on this, you'll calculate debtors, and based on this, you'll calculate interest cost. Let's see it in few questions. You'll understand this format when we do a problem. Radiance Garment Limited manufactures ready-made garments, sells them on credit basis through a network of dealer. Present sales 60 lakh, 20 days credit period. Company is contemplating an increase in the credit period with a view to increasing sales. Variable cost 70%, fixed cost 8 lakh per annum, pre-tax return of 25%. Proposed credit policy, collection period 30, 40, 50, 60, sales increase to 65, 70, 74 and 75. Which credit policy should the company adopt? Present your answer in tabular form, 360 days, 2 digits after decimal. Go through the question. Just quickly go through the question first. Okay, there's an original scenario and they have given some rework scenario saying that policy 1, credit policy 1, credit policy 2, 3, 4. Let's capture the data given in the question. Sales is 60 lakh, it can go up to 65, 70, 74, 75. Variable cost is 70% of sales. Fixed cost is not given in the question. Sorry, fixed cost is 8 lakh. Fixed cost is 8 lakh. It will remain same whether sales go up or come down. Gross benefit is, it's a purely format driven area. Gross benefit is this. Any information on bad debt? No. No cash discount, no credit administration, nothing is there. Okay. Then I have something called as interest cost, which is dependent on debtors. Full cost of sales is variable cost plus fixed cost. Variable cost plus fixed cost is called full cost of sales. Variable cost plus fixed cost. Question has not said debtors have to be valued like this, like that, nothing is mentioned, then we follow this. Originally we are giving a 20-day credit period, so this into 20 by 360, 20-day credit period, 20 by 360. Next we are increasing it to 30-day credit period, 30 by 360. Then we are increasing it to 40-day credit period, 40 by 360. Then we are making it 50-day credit period, and finally we are making it 60-day credit period. So we take that number into 20 by 360, 30 by 360, 40 by 360, 50 by 360 and 60 by 360. Your interest cost is depends on the return which the company wants. They want a return of how much? 25%. So this into 25%, into 25%. Every question I'm going to do the same thing. So this is my interest cost. My net benefit is whichever gives me highest net benefit, I'll choose that. I'll choose policy 3. I'll choose credit policy 3 because that gives me the maximum net benefit. That gives the maximum net benefit. So which is for giving a credit period of 50 days. We'll give a credit period of 50 days because that gives me the maximum benefit. Clear? Any doubts on this? Let's look at this. You're going to see mostly the same thing I'm going to do. A company is presently having credit sales of 12 lakh. Existing terms are 1 by 10 net 45. What is 1 by 10 net 45 is you will get 1% discount if you make the payment in 10 days. Otherwise, you need to make the payment in 45 days. Average collection period is 30 days. So some people could be paying in 10 days, some people could be paying in 45 days. On an average, I collect my money in 30 days. Current bad debt is 1.5%. In order to accelerate the collection process, the company is contemplating liberalization to 2 by 10 net 45. Instead of giving 1 by 10 net 45, I want to make it 2 by 10 net 45. Sales will increase by 1/3. Bad debt will increase. Collection period will decline. Contribution to sales is 22%. Opportunity cost is 15%. 50% of customers in terms of sales revenue are expected to avail cash discount under existing. Tax rate 30% should the company change its credit policy. I'm going to do this question also. Beyond this, I would want you to try it out. So the same format, I'm not going to do anything beyond this. Original and revise, that's all. Only two policies are there, original and revise. What is the sales today? 12 lakhs. The sales will go up to how much they are saying? Some increase is going to happen in the sales. 1/3. 16 lakhs. Variable cost, what is the percentage? Variable cost, how much percentage? Somewhere that variable cost percentage is given in the question in an indirect manner. Contribution is 22%, so variable cost is 78%. Anything on fixed cost? If not there, we take it as 0 and proceed ahead. Anything on fixed cost? No. Anything on bad debt? Okay, 1.5% of sales. Then it increases to 2%. 1.5 and 2%. 1.5 and 2%. Cash discount they are saying, as of now I am giving 1% discount, okay. I want to make it 2% discount and they are saying 50% people today and 80% people later will take this scheme. 50% and 80% of customer in terms of revenue are expected to avail cash discount under existing and liberalization scheme respectively. So today 50%, later it is 80%. So this is sales. 50% people take the discount and discount is 1%. 50% people take the discount, 1% is discount. This is 80% people take the discount, 2% is discount. 80% people take the discount, 2% is discount. No credit administration cost. Coming to debtors figure, I copied the variable cost plus fixed cost. There is no fixed cost in this question. Variable fixed. What is the collection period today? How much is the collection period? No. 30 days. Later on it is becoming 20 days. The average collection period is 30 days. Later on it is becoming 20 days. And my interest cost percentage given in the question is 15%. 15%. That's all. The problem is over. 2,28,300 and 2,84,000. I'm okay to go with the liberalization scheme. I'm okay to go with the liberalization scheme. Clear? Any doubts on this? Every question you put it in this format, you will get to the solution. Any doubts in this? Do the next one. The only difference, the only thing I want to talk just for a minute. If they give you debtors turnover ratio, listen. If they give you credit period, you do full cost of sales into credit period by 360 or 365. If they give you debtors turnover ratio, full cost divided by debtors turnover ratio will give you the debtor. Divided by the debtors turnover ratio. Please do it. Put it in the same format. Put it in the same format and get to the answer. You may have some of the items. It's not necessary to write this fully, okay? I have just kept it at this format. Whatever item is available, you have that. If, for example, credit administration was not there in this question, so put it in this format and then let me know the answer. Quickly do it. Present policy, option 1, option 2. Do it quickly. The same format, nothing there to be done. $11,50,000 in the revised policy 1, I think. Policy option 1 has the highest net benefit. Debtors will be full cost of sales divided by debtors turnover ratio. You'll have to divide by the debtors turnover ratio. Normally you'll have to do into credit period by 360, 365. Here you'll have to divide by debtors turnover ratio. Any doubts on this? Clear? Can we proceed? Any doubts? Okay, let's come to 21. It's a slightly different question. Let's come to 21. Any doubts on the earlier question? Okay. A company has sales of 25 lakh, collection period is 50 days, bad debt loss are 5%, collection expense are 25,000, cost of funds is 15%. Two alternative collection program, evaluate which program is viable. It is similar to the previous set of questions and all, but this is not a credit policy, this is a collection policy. The difference is simple. Credit policy means you give more credit to customer, because of that sales can go up. What is collection policies? If you have one employee, you may collect the money in 100 days, but if you increase the number of employee, it is possible to collect the money faster, because they are going to do quicker, they are going to do a lot of follow up, and that's possible. So in this question, I can increase my collection expense, reduce my collection period, reduce my bad debt. I'm going to do it like the previous question only, but we will do only this 4. Only the costs are there. There are no benefits given in the question. Sales is there, but I don't know what is the cost of sales, and I don't want to capture also, because the sales is going to remain same for all the option. Your variable cost of sales will remain the same for all the option. Gross benefit will remain the same for all the option. So this is a problem. We are going to do it in the same format, but our focus will only be this part, which is bad debt, cash discount, credit administration, interest cost, and there's no concept of net benefit and all. So we'll call it as bad debt. I don't think so. Cash discount is there in this question. Credit administration, interest cost, and total cost. We will select a plan which has the lowest cost. We'll select a plan which has the lowest cost. And debtors, when you estimate in this question, that estimation will happen only on the basis of debtor estimation. In this question, you don't have a choice. You'll have to do only on the basis of sales, because you don't have information on cost of sales. Sales is 25 lakh. I don't know the cost of sales. I don't know the cost of sales. So for example, if I start with bad debt as of now is 5% of sale, 1 lakh 25,000. It can become 4%, 1 lakh 75,000. Collection expense, credit administration is collection expense. Today is 25,000. Then later on it will become 50, 80. Interest cost is 25 lakhs into, today the collection period is 50 days by 360 or 360, I am taking 360, even you can take 365, doesn't matter, into 15% cost of funds, into 15%. Same 25 lakh, now the collection period is 40 days, and then it becomes 30 days, whichever has the lower total cost, I will go ahead with that plan. Whichever has the lower total cost, I'll go ahead with that collection policy. Sometimes in an exam scenario, this happened in only one exam, they may forget to give this number, then you assume some cost of funds and proceed. Interest cost will be there in all question, because if the collection data is given, so you will have interest cost in all the question, but if in case that data is missing, you please assume a interest cost and proceed ahead. Clear? Any doubts on this? Go through 22. Okay. As a part of the strategy to increase sales and profit, the manager wants to sell goods to a new customer who has a 10% risk of non-payment. We'll put it in the same format. The only difference here is this rate is given after tax. Maybe we have not noticed it till now, but every question had used the word pre-tax rate of return. Every question was using the word of pre-tax rate of return, or it was silent. Now this 25% is used to calculate interest cost. This 25% would be used to calculate interest cost. I'll convert this 25 divide by 1 minus tax rate, and 50% is the pre-tax rate. 50% is the pre-tax rate. 25% is after tax. I cannot work with after tax. I will have to work with pre-tax rate of return, because in my calculation I don't subtract tax. I don't subtract tax. So I'll come to this 50% in some time. The sales to these customers is 1 lakh. The sales to these customers is 1 lakh. The production and selling expenses 80%. No fixed cost. So the gross benefit is 20,000. 10% risk of non-payment. Debtors is 80,000. What is the collection period? How much is the credit period given to them? How much is the credit period given to this customer? 1 point. So debtors is 10,000. Everything is same manner. Just that you cannot take 25% given in the question. It has to be 50%. It has to be 50%. Why it has to be 50%? Because that 25% was after tax. So I make this 50%. If you still have a net benefit, go ahead and give credit to this customer. If you still have a net benefit, go ahead and give credit to customer. If the net benefit was zero, we are indifferent. And it technically means you are getting a return of 50%. The 25% was given. No, you get a return of 50% if exactly net benefit. IRR is the rate of return at which NPV is 0. Similarly, if net benefit turns out to be 0, that's the net return I am earning. I wanted some return. The return would be equal to whatever we had been given in the question. The question had said 25% return after tax. We converted into 50%. If the net benefit turns out to be 0, we are earning that return. Net benefit is positive, we are earning a higher return. Net benefit negative, we are earning a lower return. Same concept in IRR. If NPV is positive, IRR is more than the discount rate. If NPV is 0, IRR is equal to the discount rate. If NPV is negative, IRR is lesser than the discount rate. The reason for discussing this is, the next part says, I want to know what should be the risk of non-payment if I want a return of 30, 40 and 60%. Listen, I am going to repeat this calculation fully. I'll keep the net benefit as 0, okay? Net benefit as 0. I want a return of 30, 40 and 60. So debtors is 10,000 into 60%. What is 60%? Is 30% after tax. Before tax is double of that. 40% means 10,000 into 80%. 10,000 into 120%. 10,000 into 120%. 30, 40, 60 is the after tax. We are converting into pre-tax. For converting into pre-tax, you are technically doubling it. You divide by 50%. Bad debt is a balancing figure, which is 14,000, 12,000, 8,000. Indirectly, 14,000 means 14% risk of non-payment. 14,000 is 14,000 on sales of 1 lakh. If there is a 14% risk of non-payment, it is possible that I will earn a return of 30% after tax. I will earn a return of 30% after tax if there is a 14% risk of non-payment. If there is a 12% risk of non-payment, I will earn 40% return. And if there is a 8% risk of non-payment, I will earn 60% after tax. I will earn 60% after tax. Your bad debt is a balancing figure. Bad debt is a balancing figure, because when net benefit is 0, it means you are earning that return. Net benefit is 0, it means you are earning that return. So degree of risk of non-payment is 14, 12 and 8%. 14% will give you 30% return. Risk of non-payment comes down, your return will go up. 12% means 40% return, 8% means 60% return. Any doubts on this? 14, 12 and 8. Okay, go through this and put it in that format. Go through 23 and put it in the format. Go through 23 and put it in the format. Quickly do it. Go through this question and put it in the format. quickly put it in the format. Put it in the format quickly. Do it and let me know. The table would guide you to the solution. I'm not going to extend this policy, the liberalization or whatever they're asking. That's not going to be done. One place where you could have made a mistake, fixed cost should be 8 lakh for both scenario. If you take it as 10% and make 8 lakh 50, I can't help it. It has to be 8 lakh in both the scenario. Fixed cost has to be 8 lakh. That's a place. If you have made a mistake, then that's a little bit of a worrying sign. Please take care of that. Your fixed cost cannot change. Balance is more of a formality, nothing much. Fixed cost alone, if you could have made a mistake, that is avoidable error. Please take care of that. Any doubts on this? Okay, let's come to 24. Now onwards, I think we may have a little bit of a different set of questions. Still the similar format can be done, but let's come to 24. Some of the questions I'll solve it, some of the questions we'll discuss it. Let's come to 24. Tony Limited manufactures color TV set and is considering liberalization of existing credit terms to 3 of their large customer. Credit period and likely quantity that will be sold is 0, 30, 60, 90 is the credit period. Units which can be sold. Selling price is 9,000, contribution is 20%, cost of carrying receivable is 20%. Determine the credit period allowed to each customer, assuming 360 days in a year for calculation purpose. Listen. I'm not going to tell you to do solving now, but it's the same format. You're going to put it in the same format. Customer A, what you will do? 0 days, 30 days, 60 days, 90 days. You will have to do a statement for every customer. What you will do? Sales, less variable cost, less fixed cost, gross benefit, less bad debt if at all there, less your credit administration cost, less cash discount, less interest cost, and you get a net benefit. Customer A, I am not going to do anything because his sales does not change. So it's better to give him a no credit period. Whether you extend credit period or you don't extend credit period, he is very clear that he will buy only 1000 units. So let's give no credit to him, because when I give credit, I'll have interest cost. In customer B, the sales keeps changing. So what you will have to do is you will have to do the statement in the same format. Sales less variable, less fixed, gross benefit, less interest cost, net benefit. The net benefit is the highest at 90 days. The net benefit is the highest at 90 days. Similar statement you will have to do for customer C. The net benefit is highest for 90 days. So for both of them, the net benefit is highest at 90 days. You will have to do the statement which I have told till now, but you will have to do customer wise. You will have to do this customer wise. Now another thing they are saying is, what are the problems the company might face in allowing the credit period as mentioned above. Now the analysis says customer B you have to give 90-day credit period, customer C you have to give 90-day credit period, customer A no credit period. If customer A gets to know about this, it can become a trouble, because he is not being given any credit period, whereas others are given credit period. Also the table says customer C, for 1000 units itself you are giving him 60 days credit. So this customer A can very much ask for this credit. Customer B is buying 2000, for example 1500, at 1500 here it's 90 days 1000. So you cannot have varying levels of credit for different set of customers. So that can become a problem. Customer A is taking 1000 TV set where credit is there or not. Customer C is taking 1000 at 60 days. Hence A may also say please give me 60 days credit. B will take 2500 for credit, whereas C is taking only 1500. In such case, B will say give me further relaxation, because I am anyway buying more than that the other customer. Just give me a minute. Okay, not needed. It is exactly the same format. I don't have anything there. So I'm not discussing question 25. Nothing much is there. Okay, let's come to 26. It's again a different set of question. A bank is analyzing the receivables of Jackson Company in order to identify acceptable collateral for a short-term loan. The company's credit policy is 2/10 net 30. Bank lends 80% on accounts where customers are not currently overdue and where the average payment period does not exceed 10 days past the net period. A schedule of Jackson's receivable has been prepared. How much will the bank lend on pledging of receivables if the bank uses a 10% allowance for cash discount and returns? So I go to a bank saying that I have debtors of 1,08,800. Can you give me loan against this? Now for getting a loan against this, there are two rules the bank is saying. The customer should not be currently overdue and the average payment period should not exceed 10 days past the net period. The net period is 30. This outstanding should not exceed 30 first. The outstanding should not exceed 30. So this customer is eliminated. This guy is eliminated. 91 and 114 will not get any, I will not get any loan against 91 and 114 from the bank. From the bank, I will not get a loan. This is one first condition. First condition is it should not be overdue. Overdue is 30 days. I am assuming 30 days is the credit period. Second, historical payment period should not be 10 days post the normal net credit period. So the historical data should not be more than 40 days. In this customer is also eliminated. This customer is also eliminated. See, for example, I think 74 is not overdue and historically also is fine. 107 not overdue, historically fine. 108 not overdue, historically fine. 116 not overdue, historically fine. 123 not overdue, but historically there is a problem. Historically there is a problem. So I will get credit on 4 accounts, which is, it adds up to, can you tell me the total of this first? Tell me the total of this. Total of these 4. In that only 80% will be lent. In that only 80% will be lent. In that another 10% the bank is going to deduct for some allowances, some return, something has been mentioned. So net the bank will give a loan of 48,816. 48,816. Go through question 27. Go through 27. Go through the question. Okay, now let's discuss this question. I am doing business with this customer. The credit period could be anything, but historically this guy doesn't seem to be paying the way I wanted him. He pays 15% of the bill in 30 days, 34% of the bill in 60 days, 30% of the bill in 90 days, 20% of the bill in 100 days, and 1% is bad debt. Now if I put it in this format, the sales with this guy is 15 lakhs. The sales with this customer is 15 lakh rupees, and what they mention is 15 lakh sales. The selling price is 150, profit is 5 rupees. Selling price is 150, profit is 5 rupees, so cost is 145. Cost is 145, which will broadly work out to be 14 lakh 50,000. 14 lakh 50,000. Also there is another expense of some 5,000 recurring expenditure. So my gross benefit is only 45,000 rupees. My gross benefit is 45,000. 1% goes in bad debt. The problem is with interest cost calculation. It is going to be slightly tricky now. So I have to come to the interest cost calculation. I have calculated bad debt, everything is fine. Now coming to interest cost calculation, listen. My debtors is 14 lakh 55,000 cost of sales. 14 lakh 55,000 is the cost of sales. In that 15% of the bill, 15% of the bill is paid within 30 days. What is the interest cost given in the question? Interest cost. 24. So this is the interest cost for the first 15%. 14 lakh 55,000 into, let's not do the calculation, into 15%, because 15% of the bill would be paid into 30 days. So this amount is due for 30 days and 24% is my rate of interest. Then next 14 lakh 55. Next segment what percentage? 34%. How many days? 60 days into 24%. So this is another expense for me. This is another expense. Third segment 14 lakh 55 into what percentage? 30%. 90 days 24. Fourth segment 20%, 100 days. This is my interest cost. This is my interest cost. So interest cost is going to be done in a slightly longer manner, because he's not, if it was a single credit period I could have done it, but this guy is working with multiple credit periods. So 15% of the sales, 30 days, this much is the cost. 34%, this is the cost. 30%, this is the cost, 20%, this is the cost. Net interest cost is so much, net benefit is negative. So no point in doing business with this customer. No point in doing the business with this customer. Clear? Any doubts on this? 28, I'm not doing it. It is going to be pretty much the same format which we had done. You'll put it in the format. The only thing is this cost, this question also has some increase in fixed cost. So you'll have to give effect to that as well. Normally fixed cost is written as same amount. This question talks about some change in fixed cost. Just give me a minute. Okay, this is also not needed. Just give me. Just give me a minute. Okay, I come back to this question. Okay, question 23 which we had done. 1/10 net 30 was the credit period in that question. 50% of the customers were taking credit. Listen, some question in exam this data may be missing. Average collection period is 20 days. Average collection period is 14 days. This data could be missing in the question, but they will tell you what percentage of people are taking discount, what percentage are not taking. In that question, originally 50% were taking discount, 50% were not taking discount. If the collection period is not given, average collection period is equal to people taking discount 50% into 10 days, people not taking discount 50% into 30 days. This is how you will calculate the average collection period. 50% into 10 days plus 50% into 30 days. After discount is given, 80% into 10 days, 20% into 30 days. This will be 20, this will be 14. It's not necessary that this calculation has to match with what is given in the question. If problem does not give you the collection period, you will have to do this. Problem has given, then because the collection period can be even different than this. Because I tell my customer to pay in 30 days, some customer may even pay in 40 days. So that's beyond my control. If the collection period is given, great. If it's not given, it is equal to weighted average of people taking the discount, not taking the discount. People taking the discount pay in how many days, people not taking the discount pay in how many days, and then do the calculation. No, I think every question has given that data. Every question has given the collection period data. I think there was one problem, but I don't think so I have in this. In my regular material, I think I have one question. Let's come to question 30. This is on factoring. I'll move to factoring now. I'll move to factoring, go through question 30. Okay, now let's first understand what is a factoring kind of a question. See, factoring is basically an arrangement where I am not ready to collect money. I tell someone else to collect money on my behalf. So I give this responsibility to someone else. He will do the job of collecting money from the customers. The benefit for me is I can focus on my main business. So I will not focus on this credit administration, collection effort, bad debt risk can come down, but the factor will also charge a commission. There will be two types of question. One, the question will ask you for effective cost of factoring. Second, the question may not ask you for an effective cost of factoring, but they'll say whether a factoring arrangement is to be entered or not. In that also, you may have to calculate an effective cost of factoring. In those type of question also, we may have to calculate an effective cost of factoring. Sometimes we cannot calculate effective cost of factoring. When you cannot calculate, I'll explain as we proceed. This question wants us to calculate effective cost of factoring. For doing effective cost of factoring, first we calculate working note 1, computation of amount lent by factor. Again, it's a format driven area. Computation of amount lent by factor. Amount lent by factor. Particulars amount. computation of amount lent by factor, annual sales, I'm doing it in lakhs, 320 lakhs, annual sales is 320, debtors is 320 into what's the credit period we give to the debtors here, 90 by 360, debtors is 80 lakh. My factor will not get to know what is the profit, and also when you do factoring it's always on the sales only, no concept of cost of sales, because the factor will never get to know what is the profit margin. So basically I'll go to the factor and say I have 80 lakh of debtors, can you give me a loan against this? For that what the factor will do is he will deduct certain items. He is going to deduct reserve of 10%. He is going to deduct reserve of 10%, less reserve, first reserve would be subtracted by him. He will also subtract his commission, because before lending this money he will say I want to subtract my commission. So the commission which this factor has is, when you go to bank and ask for a loan, the bank will, for example, if you give a gold worth 1 lakh rupee, the bank will not give you a loan of 1 lakh. He'll say your gold is worth 1 lakh, I'll give you a loan of only 80,000 or 70,000. I want some protection at my end also, no? So why will I give the entire amount? So 10% is there. In that earlier question we did 80% bank was funding, 20% was deduction. On top of that another 10% was also deducted by them. Less commission, commission is 2%. Amount eligible to be lent, ideally this much money I should get this much money from the factor. Now factor is going to say I'll give you this money, but let me deduct my interest also. There's an interest cost which is 18%, so he will deduct this also, less interest, this into 80%, rolling period is 90, every 90 days this money will keep rolling, into 90, and amount lent by factor. Factor will basically give this money. I wanted 80 lakhs, I will get 67 lakh 23,200. I wanted 80 lakh rupees, I will get only 67 lakh 23,200 from the factor. This is the first thing. Then working note 2, effective cost. Effective cost, costs, commission, interest. These are the two expenses the factor will mostly charge. Commission is on the entire sales. Now we are doing the annual calculation, 320 lakhs into 2%. Interest what you calculated here was for 90 days, so into 360 by 90, into 360 by 90, or in other words it is this amount, eligible amount into 18%, eligible amount into 18%, which is 12.6720, eligible amount into 18%. 1 year calculation. Now these are the expenses I have to incur for the factor, but there are certain benefits also. I will save on bad debt, credit admin cost. I'll save this money. The bad debt as of now is 1.5%. My assumption is when I do this factoring, the loss of bad debt, the factor will bear this. That's an assumption. 320 into 1.5%. Credit administration, I'm going to save 5 lakh rupees on collection of money. So net cost, I will be spending 9,27,200. I will be spending on factoring only 9,27,200. Effective cost in percentage, 9.2720 by 67.2320 into 100. So my effective cost of factoring is 13.79%. I'll be spending 9,27,200 for one full year for getting how much? 67,23,200. That's a rolling amount. You will keep getting this amount throughout the year. So earlier which we did calculation was for 90 days. The annual calculation is done here. For 90-day period, you will get 67, 23, 200. That money goes back, you again get it back, goes back, again you get it back. So it's a rolling amount. It's a rolling amount. So effectively, your cost is 13.79. This cost would be compared with the cost of a bank loan. If the bank loan is at 14%, I will go ahead with a factoring arrangement. If the bank loan is at 12%, I will go ahead with the bank loan. I'll go ahead with the bank loan. 13 points. The above cost is to be compared with rate of interest on a bank loan to decide whether we can go ahead with the factoring arrangement. If bank loan interest rate is higher than 13.79, then we'll choose factoring. Otherwise, we'll choose bank loan. I'll take a break of 15 minutes and then continue.